Good morning, everybody. It's Dan Kautz.
Morning, Jeff Buckley.
And here we are, back on the May webinar already. Can you believe it? May.
It's going fast.
Time is moving. It was just obviously last month in April how we were talking of Liberation Day and how fast the market went down and some of the stealthy rebound we've had, stuff like that. It's just been a very fast-moving, little emotional market.
Yes.
But what's really important is we've been following the information, heading for the higher ground, and trying to keep emotion at arm's length. So let's get into it. What do you say here?
Sure.
So this is a quick check-in call. I forget, this is my slide. Quick check-in call here. No live phone calls, live texts that we can receive during recording. Contact information, dkautz@kautzbuckley.com. Jeff Buckley or J Buckley at kautzbuckley.com. Our phone number is 716-276-8480. Ever popular text line, 716-272-1129. Now that I got that out of the way, Jeff, let's talk about what happened in April.
Well, April was an incredible month. We started out, if you all recall, April 2nd, after the markets had closed. That was the date that President Trump announced his reciprocal tariffs, which really turned out to be much more significant than really anybody, especially the financial markets, was expecting. So that caused quite a bit of volatility. The next couple business or trading days, really, the markets really plummeted. This chart is very interesting because I think it just really captures how much volatility there was just in the 30 days for the month of April. And if you recall, we include this slide in all of our webinars because we look at this, we say we start with a look in the rearview mirror. So this is the month prior of April. And what this shows, though, is where the markets were at that time is we had just been setting some all-time records on the markets themselves, the stock markets. And around, January, February of this year, that's when the records were set. What this shows is by April 30th, we had taken quite a roller coaster ride. Versus the 52-week high, these are the indices that most of you have heard of by now. Dan and I follow them daily. The Dow Jones Industrials, 30 large industrial companies. The S&P 500, 500, a broad swath of our economy, 500 of the largest companies in our country. We go down to the Russell 2000, small companies. That's an index that follows those companies. NASDAQ 100, very tech-oriented. If you look at all of these, what had happened during the month of April, they dropped, just in those 30 days of April, they were dropping, if you look at the Russell Microcap, very small companies, down 20%. Russell 2000, again, small companies, they were the hardest hit in our economy, down over 20% just from their 52-week highs that they had been setting a month and a half, 2 months before. So significant drops. However, we weren't done yet. Then when we hit April 30th, the end of the month, we were then rebounding. And where they had gone, now this actually represents the 52-week lows as well, because this is where, if you go back a full 12 months, this is where these indices had been down, and then that they did is they bounced. And we had then, just like the Dow Jones Industrials, by April 30th, it was up 11.1% from the low it had hit weeks before. And what was causing that was the initial shock of the tariffs. Then you had the response from the companies where the tariffs against which the tariffs were imposed. And then what happened is you had periodic announcements that were coming out where we were making progress with these trading partners and negotiations and everything. So it was up and down constantly. And that's how we ended up finishing the month. So quite a bit of volatility, very unusual. But something that Dan and I, one of the sayings that we adhere to, we repeat all the time, it's your time in the markets, not timing the markets. And really what we mean by that is we're not timing the markets to try to respond when it's down at its lows and get in, get out, jump in and out. We're staying invested. We believe in these companies that we're investing in, so we're staying with them. And you get rewarded when you finish the month with those bounces off of the lows.
Yeah, it's not even get rewarded at the end of April. How about May alone?
Well, yeah. So
we'll talk about that in a second.
Yeah.
Let's take a look at some of the sectors you were talking about.
This was just, I think this really highlighted why the tariffs were so important to certain sectors. Now, there's some in here, like you've got utilities, all right? Well, a tariff against China or Vietnam is not really going to limit the utility, the power generation in this country. However, you look at consumer discretionary spending. That's your Walmart, your Amazon, your Target. Those companies stock their shelves with goods made in China. And if they can't afford to import those goods any longer, or they can import them, but the price is going to be 125% more than it was because of the tariff, those companies could potentially suffer. The markets recognize that. The immediate response to the tariffs was a significant drop. However, as we started to realize toward the end of April, again, we're looking at that bouncing off those lows, that there was some light at the end of the tunnel. We were going to work out some arrangements here with these companies. Now, it's going to take a while. This is a huge shock to the system, but the point is that some of these sectors are clearly much more impacted than other sectors.
And then when we look at the next slide, where are the negatives, Jeff?
Yes, yeah, that's
Holy
right.
cow!
Yeah.
What a difference a month makes.
Oh yeah, last month when we did in the webinar, we were right about the first or second week in April, and that was right after the tariffs had been imposed. So honestly, and I should start out by saying, this is our chart, and those of you that watch every month, you know what this kind of represents. This is much more representative of our clients' portfolios. If you're a little bit more of an aggressive investor, you might have about an 80% equity allocation stocks, 20% fixed income. The more conservative you are, you might be more down here, middle of the road, maybe a 65% allocation to stocks, 35% to fixed income. But the point is, at this time last month with our webinar, this entire column was all negatives and fairly significant negatives.
And it's beginning to roll through, too.
Yes, and it is starting to affect the 12-month returns and the 3-year returns, whereas now you see that with what happened through the end of April and then even up through the 7th day of May, we've been able to, these have now turned negative. So we basically put that huge amount of volatility and the negativity behind us, and we've basically stabilized again here too, because it was such a short time period, less than a month, that it didn't really have, at least at this point, it hasn't had a lasting impact on your longer return averages.
On the returns, that's true. And also I'd like to point out May 7th, that was a Friday, I believe we ended up at, right?
It could be, I'm not sure.
That. Yeah. But what happened over the weekend?
Yeah.
You think these numbers look great. You know, over the weekend, a deal was made with China. The Trump administration said, hey, listen, even if the deal isn't sealed in 90 days, we're not going to impose any more high tariffs. So that's really pretty good news. I mean, it's still a relatively high tariff, around 30% as we talk today to China, but it's a whole hell of a lot better than 145.
It is.
So, you know, put it in whatever lens you want to put in. It seems like we're taking the right step forward here, and long-term damage to the returns looks like we have sidestepped that.
For now, at least, yes.
And it looks like recession may be, you know, now we don't really have to focus or talk about that. It is early in the year.
Yes.
So let's move on to the next chart. And these are our speedometers from City National Rockdale. Jeff?
Yeah, well, and this is where we try to attempt to look out the windshield now. You know, we've kind of looked where we are currently. The prior slides were the rear view mirror. This is something that we refer to every month. It's produced by one of the money managers we work with, City National Rockdale. Dan and I just really like it because it's a quick visual look by color and by speedometer as to different sectors of the economy where we stand. And if you recall, I mean, this has fluctuated significantly over the years that we've been doing this. I mean, we had some years, or some months, I should say, where there was a lot of green, some months where there was a lot of red. Now, we were starting to turn more toward the green, and we backed off a little bit because City National says, look, our outlook says we've got this tariff issue now that's come about beginning April 2nd. We need to work our way through it. We're not saying the wheels are going to fall off and everything is gloom and doom, but we're also not saying that this is something that we're just going to shoot through and continue a meteoric rise in the markets. We're neutral on a lot of things. So there's a lot of different aspects here. You know, some, as Dan likes to point out, I mean, some of these are a little more of the softer data, consumer sentiment, consumer spending. There's some harder data there, but labor markets.
where we actually get hardcore reports. But I love your analogy with the cars. We're going to start doing some icons with cars here. The rear view mirror, the front windshield, and quite frankly, we're driving a standard and we're neutral. We're looking for gear to get into. And I really hope that over the weekend that we just had, we have it in the right gear, haven't missed shift, and we can get some traction and move forward. So going into some of like putting this in perspective, when we look back at what happened on Trump's first term, this is all different this time, Jeff?
Well, it's actually this is some charts that were put together. I review a lot of stuff to decide what to include in this, and I saw these charts that are one of the money managers we work with, American Funds. They had put this together, and I really liked it. It's just a couple slides here, and we'll work through them. But what they're essentially saying is, let's focus on perspective. Let's take what happened in April and put it into some perspective, looking back, not just weeks and months, but looking back years. So one of the first things they start out with in 2018, the first Trump administration, sounds very, very similar. Tariffs on China sparked a trade war, panicked the markets, dominated the news. Very similar, all right? There was fears that there would be a trade war between the world's two largest economies. The S&P 500 fell. Now, it's kind of funny because down 19.4% from September to December, we did about 19.4% in less than 30 days. Yes, but a similar drop. But then if you look, the index recovered sharply in 2019, up 31.1% as trade deals were announced and consumer spending steadied. Exactly what we're going through right now. Some trade deals, or at least frameworks being set forth. Consumer spending is starting to even out a little bit. So the chart, I think, is their attempt here with this chart is to say, let's keep it all in perspective here. So, and you can jump to the next one there. This one is this is an interesting one. This takes a look at a lot of historical time periods and events that have occurred during that time, and basically says, okay, what happened when the markets pulled back significantly there? And you can see market declines of at least 15%. Well, there have been a number of them, and you could probably, just picking a couple here. I mean, there's just some specific events that occurred worldwide, and the markets respond to those. However, the subsequent 12-month return to a significant market pullback like that has really been pretty substantial. Average 12-month return after a steep market decline, 52%. So again, some positivity there and keeping it in perspective for the longer term. Here we go. The cumulative price return for each S&P 500 bull and bear market. So this chart is looking at both. We had a bull or a bear market here, going all the way back in the 50s, 60s, 70s. The bull markets the bear markets are in red, and you can see a kind of a gut-wrenching, emotional pullback. Average bear market total return minus 33%. That's very significant. But when you look at it from a longer-term perspective, you see that those significant pullbacks in the market were relatively short. They were deep, but we were able to recover. And each one of those bull markets, average bull market 67 months in length, total return about 265%.
Now take a look at that. 67 months in a bull market, 12 months in a bear.
Right. So again, it's the longer term perspective. That time in the market allows you to weather these quick pullbacks.
Absolutely.
So this one, one of the things Dan and I harp on a lot too is a diversified portfolio. And we have struggled with that a little bit over the last maybe 4 or 5 years because bonds were always part of our clients' portfolios to provide some stability during market turmoil, and also to give you some return. And we've had a couple instances over the last 4 or 5 years.
Specifically, think of the 2022 to 23 where interest rates rose up so high.
They did, and I mean,
nowhere to hide.
Right, it affected both the stock market and the bond market, so that was difficult. However, what this chart is showing you now is, yes, that it has occurred in the past, but those investors with diversified portfolios are able to see some stability provided by the bonds they currently own in those portfolios. we've got the market, the stock market volatility, but the bonds are there for that foundation and to generate that income. Right. So that's good. And then the last slide here, really, I mean, this is, I think this is important points. You know, market declines can be very painful to endure, but rather than trying to time the market, investors would be wise to stay the course. And they try to show you here, obviously we've got a lot of volatility reflected in this blue, dark blue line. Right. That's your short-term market returns. But if you compare that to that same time period and you take the long-term view, your portfolio value tripled over time. And we're not going back to ancient history either. Right. 2015, this is a 10-year period of time. A lot of volatility up and down during that time, but a positive return.
So what's the saying of the day, Jeff?
It's a time in the markets, not timing the markets.
That's fantastic. Yes. That's exactly right. I'd like to thank everybody for joining us for our May webinar. I think Jeff has said it many times. I don't need to repeat it again. But what's very important too is try and not let emotions muddy the waters. Let's follow the signs. Let's follow the signals. Let's get to higher ground. And I want to thank everybody for tuning in, but also trusting Jeff and I with your family's wealth. So have a great week, and we'll see you next month. Bye-bye.